Thanks for tuning in to this year-end special with a very special guest. A lot of people call him the learning machine. He terms a few people as being learning machines, but I can safely say that all the times that I've spoken with him, whether it's on a Diwali special conversation or otherwise, I've always learned something, including about some very special books to read. He's none other than Mr. Ramesh Damani, and he joins us right now on the show. Ramesh, so good having you. It's been a while. Thanks for joining in.
I know, Neeraj, thank you for your very kind words, and may you allow me to wish you and all your staff and all your audience a very Merry Christmas and a very Happy New Year.
Yeah, well, hopefully it's a very good new year. But Ramesh, I think from investing in a markets perspective, I mean, despite the externalities, it's been a rather good year, save for the last couple of months of volatility, which is probably also not bad. I mean, what's your sense about what have the last 12 to 18 months taught you about money making in the first place?
Great question, Neeraj, to start with. You're right, it's been a bumper year. And I'm one of the later converts to the bull market that took place. But having converted now, I'm full-blown in the bullish camp, despite being some skepticism because of this current fall of 10% or so, that maybe the market has peaked and maybe the bull market is over. I happen to believe that here's the intellectual case I make, Neeraj, just to answer the question further. I think if India is to survive and prosper in this era, it will have to beat to its own drum. By what I mean by that is there's some evidence to suggest that the US market, the bull market has been running for almost 13 years nonstop, is tiring or getting old or maybe even over. The reason I suggest that is because the breadth is increasingly narrow. The S&P is dominated by 5 stocks, which are powering all the gains. A lot of the tech stocks are getting 20-30%. There's an old saying that you can't fight the Fed. So the Fed is now tightening after being easing for so many years. So that itself is bad for equity markets because the valuations of the companies come down. And thirdly, of course, retail investors who typically get in at the end of a great cycle have been getting in droves. I think they own some record amounts of outstanding margin debt as you speak. Record amount of outstanding apps are floated in the US stock market. So my feeling is that the US market is aging. So now why do we have to beat our own drum? We have to beat our own drum because there's a chance. This is a very virtuous cycle we're seeing of India. And like, say, Japan in the 60s or some other emerging markets, India can now beat to its own drum because India is a large domestic economy. And the most important thing I find is that for last year, we proved that even when the foreigners come and sell in India, as they sold almost every month, the Indian market can still remain buoyant. So that gives me hope that I'm not sure yet. I think it's a work in progress, but it gives me hope that even if the Dow enters a serious correction, India can at some point break free and march to its own drum to finish the point.
Interesting. Ramesh, the common adage is that India will be tied to the hip to the world markets. 2022 will see the US growth mean reverting. And if some economies were to do well economically, it will be the one with the higher savings rate and stronger balance sheets. What gives you that hope that India with relatively a leaner balance sheet will be able to march to its own tune?
Well, a number of reasons. If you just look at what Indian earnings are said to be, what the capital expenditure is said to be, a lot of the world is now coming to rely on 2 parts of India that are very important. One, of course, is our tech prowess, a basic ability to write code and help the world digitize, which is a very paramount importance. As you know, I think India's software exports have now become bigger than Saudi Arabian oil. So that's a huge stat in our favor. But along with that, there'll be a lot of hiring in the software industry and a lot of raises, 20-30% raises for the software people, and a huge amount of hiring, which is a huge multiplier effect on the economy and will help consumption in many ways. You look at the CAPEX cycle, the government revenues are way ahead of target. So my feeling is the government will be a big capital expenditure provider for road, railways, education, water, and the like. The private sector in steel and cement are now hitting 75-80% capacity utilization. So they will be looking to set up new greenfield projects. So there is also, most importantly, political stability in India. For the first time in almost 30 years, for the last 5-6 years, we've had political stability in India. The government speaks with one voice. There's one diktat. And there seems to be an urgency now to settle the reform that had been delayed for the last 5 years or so during Modi's term 1. So I think there'll be a more urgent focus on reforms. And for the first time in India, we're not looking at, Neeraj, in my view, of trying to divide the pie. The whole Indian socialist ethos used to be, let's divide the pie more equitably. But for the first time, we are now looking at growing the pie and then dividing the pie. So I think that augurs well for economic growth. And I can't say this for a fact, but I'm fairly hopeful that the Indian bull market that began sometime around the lows of the pandemic of June 10, 2020 will continue. Maybe go through a correction of a few months. That won't surprise me at all. And that should be good. Markets had a huge run up. So there's nothing wrong with expecting a consolidation of 6 months. But from where I see and from where I invest, it seems to be we are in a long-term bull market, and we're barely gone through the first few overs of that.
Interesting. Ramesh, just a small fun question thrown in between. I remember an event that we did in some time back, when you told me it seemed to you that God had chosen you for special punishment, wherein all the stocks that you held went down. I believe that things have reversed. Looking by your smile, the last 12 months have been good for you.
Yeah, fair question. I mean, it's hard. I mean, if you haven't done well in the last year, you're probably in the wrong business, and you should probably sign out. It's been a fabulous year. But here's the thing I found, Neeraj. I mean, not all the stocks have done well. Some have underperformed, some have overperformed. But this is what I've learned in 30 years in investing in India, or maybe even now 40 years. I'm pretty old, as you know. So what I have learned is that, see, when I joined the market, we had a physical trading floor, and the index was 800. The Sensex was 800. Today, it's closer to 60,000. So it's been a 60x move in the last 30 years or so of the index, compound rate roughly 15-16% without dividends out there. So what it has taught me and a whole generation of investors is buy a good quality businesses and remain invested. You cannot time this thing, because the beast will slow down for 3 years and then suddenly spark up. To give you an example of a particular stock I had in my portfolio, I've held it for 20 years. And if you look at the CAGR, it's like 12 or 13% CAGR. So nothing great, nothing extraordinary over that return. Safe stock, gave me a good dividend yield, was in the technology business. And then because of the pandemic, the stock went up 10x. And suddenly the CAGR has gone from 12% to 32%. Wow. So, the lessons I've learned is that if you buy a good quality business and are fairly patient, there's a proverbial pot of gold at the end of the rainbow.
Right, the winners. I think I heard you lay out this statistic, which I have not paid attention to, but then I kind of took note of it, that everybody gets worried by the rise from the lows of March 2020. But if one looks at this bull market, arguably from 2008, then it's not been a very meteoric rise. It's been 12-13%. So it's a fairly normal return giving market. And people shouldn't try and think that, oh my God, the returns have been too fast too soon. Right, Ramesh?
Exactly my point. I mean, those returns are back-ended now in the last 2 years as opposed to from 2012. So, India, has gone through various phases of economic policy. But finally, we are now seeing very buoyant tax collections, thanks to GST, personal tax collection, indirect taxes collection. So the government actually, for the first time that I recall, has more money than they know what to do with it. So they'll have a huge surplus. They'll find a way to spend it. I'm very sure about that. But first time they have that. Wages are rising in India. The big question that plagues global market inflation, and is it transitory or is it more of a spiral inflation? And while the Fed has to act, given the fact that US inflation was at 6.8%, the highest in 40 years, the Fed had no choice but to act. They can't seem to be twiddling their thumbs in the face of 40-year highs inflation. So whether they believe it's transitory or whether they believe it's a spike, they had to act. I think they acted properly in terms of warning the market that there could be rate hikes ahead, and by cutting down the tampering. But I think as the months roll on, they will realize that the inflation due to oil, surge in energy prices, is already coming down. Oil has already become more reasonable. And secondly, the supply bottlenecks, which cause a huge surge in prices of goods, the dislocation, are now starting to ease. Container traffic is easing down. Used car sales prices are coming down. And there's been no inflation in services anyway. And the stimulus that had come, and which is leading a huge bump up in demand for goods, is now coming to an end. So my feeling is that while the Fed is ahead of the curve, trying to show Elizabeth's mandate of trying to curb inflation as number one priority, had to, make the announcement that they made. But my feeling is that as we move on to the balance of 2022 in June, July, inflation will start coming down to a more reasonable 2-3%. Because the reason that led us to this part of the economy, a youth savings glut, China deflationary of product, is still intact in the world. So notwithstanding all this threat about deglobalization, I think the world will, continue to be globalized and continue to be sourced at cheaper sources. And what helps India in all of this is the new China plus one policy. So a lot of industries are now going to be positively impacted, textiles, specialty chemicals, a little bit of manufacturing. So a lot of this China one policy actually helps India. And of course, tech, at the end of the day, the boys that brought us to the global table are still going to take us at a higher level by the contributions in, $200 billion worth of software exports. There's a huge amount of value addition that goes on in that business. So, I think for the first time in, maybe a decade or 2 decades, I feel that India can actually beat to its own drum. We will, of course, be buffeted in the short run by global flows, what happens in global markets. If Dow is going to be down, so is the last going to be down. But at some point, India will start overperforming.
Ramesh, having looked at various themes in various cycles, how do you look at the IT exporters? They've, as you said, brought us to the global table. When I speak to the corporates, they are all talking about the demand pipeline looking rock solid. Valuations have inched up a bit, but is it justifiable? And therefore, is it justified rather that it is done this way? And can there be more upsides over the course of the next few years? Or do you think they've run the course?
Good, Neeraj, I think so. I think, if you wanted to build a portfolio today in market, we probably would put, a good solid 25%, 30% into technology. And it's, I used to always believe that India would do better in products at some point, but that hasn't happened. It's basically the services guy that have, bought the bacon home, bought the bread and butter home, if you will. And, it would seem the large cap, tech stocks still doesn't seem very challenging, according to me. The big debate, of course, ranging is that, the people who missed the tech boom in, say, 2000 are now missing the new economy boom, and you're missing out on the digital economy. And, what I'd like to remind my friends who tell me that is that when Infosys came public, I was on the floor of the exchange when it came public. It came public at a 30 crore market cap, Neeraj. That's really hard to believe. 30 crore market cap, which even at the rate of 30 to the US dollar was $10 million US. These companies now coming with global market capitalizations, 1 lakh crore and 1,25,000 crores. So part of investing, of course, is, what price is high enough or what price is low enough. So, I think in this whole digital, spectrum that's playing out, I would tend to favor the services company. There are 4 or 5 major service companies that do an absolutely outstanding job. Someone pointed out in another interview that, TCS is a, hiring machine. They keep hiring, so many, 2-3 lakh people a year, training them, putting them mid-level, have the lowest attrition rate, is a real tribute to their management of people, their HR systems. So I think, this is, the sweet spot. We have an advantage. And I think valuations can get a lot crazier than they are at this point in the tech space.
As that meme had got viral, trespassers will be recruited. That's what some of the IT services companies are doing.
Good point. Yes.
The other point, Ramesh, is I wanted to ask this to you. This is a question that I'd saved, and I wanted to dwell a bit upon it. For the longest time that I have heard you on other forums as well as on my interviews, you look at some of the global businesses and then try and imagine what could happen in India as well. Over the last 18-24 months, have there been things like that happening across the world wherein you believe Indian businesses existing or future could come and make a mark for themselves, Ramesh?
That's an interesting question because, some of the businesses are digital, for example, the brokerages, a lot of them are digital and they will achieve global scale in a matter of time. So, I'm bullish on those businesses. On the other hand, these so-called e-commerce plays, while they're great businesses, Neeraj, something like Zomato, which I'm not recommending, but I'm just explaining, for example, it's a great business, it's a great service. But the starting point of the valuation, has to be stomached. And no matter what kind of accounting I put through, or no matter what kind of sales forecast I put through, I don't see myself getting a margin of safety in those businesses. So while I think they're very attractive businesses and they'll probably, as long as they're being able to be funded, will continue to show pretty good growth numbers. But I think the return to profitability or justifying the valuation will take a lot more. I mean, I don't know, this is still in the private space, but they're talking about a $50 billion market cap for Byju's, which is India's largest edtech company, which seems in the stratosphere to me. I mean, you have to go through a lot of pyrotechnics to justify, even try to justify that kind of valuation. So that part of the market seems extremely frothy to me. But there are extremely part of Indian businesses that have digitized, whether they are, brokerages, or whether there's some other businesses, like someone was mentioning Asian Paints and the fact that it has digitizes complete dealership. There are many businesses in India that, are doing a great, outstanding job of, digitizing their businesses. And, those are great ways to play it. Some of the new businesses, like the recent listings of spatial and geospatial maps in India look fairly interesting to me. And the valuations, while high, are not in the nosebleed territory. So, I don't think I'd paint them with all the, same brush. But at the higher end of the spectrums, the 3-4 IPOs that everyone talked about, and those are running at about 1 lakh crore market cap, they seem a bit excessive to me for the current business and the current business outlook.
There seems to be a bit of a consensus on the other side, Ramesh, which is something that you alluded to, the CAPEX theme, and the valuations, say for the MNC ones, are a lot more reasonable. Maybe order books get filled. Maybe, as you said, the government revenue running so high induces government CAPEX and then subsequently private CAPEX. You like that argument?
Yeah, I like that argument. I think from everyone I talked to about the CAPEX cycle, my friends who know this kind of cycle inside out, this is the first 10 times in 10 or 12 years, there's going to be a good degree of CAPEX cycle in India. And why hasn't it started already? Because it takes time. You earn the profit, you look at your capacity utilization, and then you start planning for new projects. So we're just getting kind of, breaking the ground on that, if you will. So over the next 2-3 years, I would be very strong CAPEX cycle. So a lot of the people that cater to the CAPEX cycle will probably be good bets at this point. Of course, there'll be a lot of, I think most of it's coming in steel, cement, data centers. So a lot of people who benefit from that would probably be the stocks to look at. But if we are wrong on the CAPEX cycle, if we are wrong on the fact that corporate risk won't grow, then of course the case for this bull market, diminishes considerably. My feeling is that those are the pillars that will push this bull market ahead. The one sector that I have often been associated with, which I haven't talked about, I still feel the public sector stocks, offer reasonable valuation. Just like how much is enough for a higher valuation, you have to argue the reverse is how cheap is cheap. And a lot of the companies in the defense, in the railways, they're facing extraordinarily healthy order books and CAPEX cycle. And in my humble opinion, are extraordinarily cheap.
Interesting. Thank you for that aspect too. Last 2 or 3 questions, Ramesh. One, it takes a lot for a man of Uday Kotak's stature to come out and say that the incumbent financials haven't been at the forefront of the digital revolution, so to say. What do you think about financials? Because they are getting disrupted, so to say, or maybe the world believes they might be getting disrupted by this whole new wave of fintech companies. How do you look at that sphere?
When Uday Kotak says something, you listen very carefully. It's clearly a very seasoned eye for investments. And but I think as we get into the CAPEX cycle, we're getting out of bad credit cycle into a vicious cycle, into a virtuous cycle. So I think as you look at large ticket items, you want to spend 400 crores, 500 crores, 1,000 crores. There are only 5 or 10 banks in India that can fulfill that kind of ticket size and order. So while the fintechs are fairly nimble and they give these buy now, pay later, and they're good business models, I have nothing against those business models, but I think both will coexist for a long period of time. I think it's, as Mark Twain says, too premature to, them off at this point.
Okay. I'm borrowing something from you, Ramesh. You had mentioned this, I believe, in an interview that you had interviewed Rakesh Jhunjhunwala, and you had told him that you don't need anybody's permission to be great. I would flip that role and ask this question to you. Can you talk about some of your best years of trading, investing, and why were you able to pick, why are you picking those years, and why were you able to make those investments back then, and do the times kind of look like there could be a repeat of sorts?
Someone said, some career actor won Hollywood in won the Oscar in the 30th year. And he kept saying, I'm not a flash in the pan. I've been doing this business for 30 years. And the secret to, doing well in the Indian stock market from when I started in 1989, the answer is very simple, Neeraj, has been compounding. I mean, I really haven't had some extraordinary year where I got I've had some good stocks, I've had some bad stocks, but ultimately, no matter what amount you begin with, you're going to begin with 10 lakhs, 20 lakhs, 50 lakhs, 1 crore, any amount of money you're going to begin 1989, 30. But if you compound that money at 23, 24%, which is broadly what a lot of us have been able to do, at the end of 30 years, you're going to end up with a fairly significant amount of money. So I think my life is more a testament to that. A lot of people made some very brilliant calls and maybe bought 2% of Infosys or maybe 1% of HDFC Bank, or maybe, got the bear market rights and managed to go short completely and clean out a lot of money in a single span of a year or so. But actually, I've not done any of that. What I've done is I picked good businesses and remained patient with them. And broadly, they've been compounded for me at about 22, 23%, which is the result is extraordinary. I mean, you may not term yourself great because of that, because you clearly weren't strong enough to buy, 5% of Wipro, say, or, whichever the great Dr. Reddy's or Asian Paints, But you bought some and you held on to it, and that stocks compounded for you for long periods of time. And the end result is extraordinary. So my point is that while getting rich is never easy, it is fairly simple. And the trick is buy great quality businesses at good prices and keep the faith. Keep the faith in India. That's most important. Keep the faith in India, that the Indian demography and the Indian democracy and Indian, uniqueness, the fact that we're such a big market in itself, the domestic market itself, even though the global market doesn't do too well, Indian with the right policy can do well itself. Those who have kept the faith, those who remain invested in India, as I've often told you, Neeraj, that I'm mostly 95% invested, okay? Whether bad markets, good markets. Maybe at some extremes of the market of 2008, I'd taken 20, 25% cash. But otherwise, I'm always invested. In the pandemic, I was 98% invested. Today, I'm 97% invested. So we remain, well invested in high quality businesses. And that has worked. What I'm saying is that at some extremes, you can get out of some positions. But otherwise, remaining invested in a high quality business and just, the nature of the beast is volatility. So if you say, I will try and sell it and buy it back, that rarely happens. Sometimes you miss this great move as happened after March 20. So, what we have learned, and, maybe it will be true for the next 10 years too, is that you stick with the high quality businesses, remain invested. And even if you are the sharpest analyst on the street or the, savviest short seller on the street, by just compounding your money at 20 to 23%, and that is with dividends, you end up at a fairly, decent place in life. So, I've had some good years, I've had some bad years, but here's what I go back and tell my track record to my son. I said that I've seen the 92 bull market, the 2003 bull market, the 2008 revival, and now this 2013. Each bull market must make you richer, stronger, and wiser. So it's not good to make a lot of money in a bull market and then lose it back in the bear market. You need to retain that money and move ahead in the next bull market. And I think a lot of those who have kept the faith and invested in Indian equities have grown richer, wiser, stronger at the end of every bull market.
That is an answer for a fitting finale. So I'll not ask a single question more. But Ramesh Damani, you wished us at the beginning of the interview. All of us wish you and family and your grandkids in particular a very Merry Christmas and a great 2022.
Thank you. A special grand wish to my grandchildren, Veer and Anna. I think they are the joy of my life at COVID. So it's been great. Thank you, Neeraj, for having me. And thank you so much for your patience.
Love having you, Ramesh. Have a great year. And thank you for speaking to us today.